Every trader, sooner or later, faces the same nightmare. A stock starts falling, and a little voice says, just hold on, it will come back. And sometimes it keeps falling and falling, turning a small, manageable loss into a catastrophe. The tool designed to prevent exactly that is the stop loss. Today we answer the two questions Micha poses. Is it even worth using? And if so, how do you place one properly? Let's start with what a stop loss actually is. It is an order you set in advance that says if the price drops to this specific level, sell me out automatically, no questions asked. You decide your maximum acceptable loss the moment you buy, while you are calm and rational, and the order stands guard for you. If the stock falls to your line, you are out, and the damage stops there. And that points to its single greatest virtue. It removes emotion from the worst possible moment. When a stock is crashing and fear is screaming in your ears, that is the hardest time on earth to make a clean decision. The stop loss makes that decision for you, in advance when your head was clear. It is discipline, written down and automated, protecting you from your own panic. It also does something subtle and powerful. It defines your risk before you ever enter the trade. If you buy at 100 and set your stop at 90, you know with certainty that your worst case on this trade is a 10% loss. You have turned a vague, scary unknown into a fixed, known number. That single habit, knowing your downside before you commit, separates disciplined traders from gamblers. So is it always worth it? Here, honesty demands we show the other side because the stop loss has a real and painful weakness. It is called getting whipsawed. Markets are noisy. A stock can briefly dip down, tag your stop, sell you out, and then immediately reverse and rocket higher without you. You took the loss and then missed the recovery, all because of a momentary wiggle. It is one of the most infuriating experiences in trading. And it gets worse because that noise is sometimes not random. Big players know that countless retail stop losses sit clustered just below obvious levels, like round numbers and recent lows. Price can get pushed down just far enough to trigger that pile of stops, a so-called stop hunt, before reversing. Setting your stop in the obvious place everyone else does can paint a target on your back. So how do you place a stop loss well? Here is the core principle. Your stop should never be an arbitrary number. Do not just say, I will risk 10% and place it there blindly. Instead, place your stop at the price where your reason for buying would be proven wrong. If you bought because the stock bounced off a support level, your stop belongs just below that support because if it breaks, your whole thesis is broken and you should be out. That means good stops live just beneath meaningful levels. Below a clear support zone, below a recent swing low, below the trend line or the moving average you're trading. The logic is always the same. Not, how much am I willing to lose, but at what price am I simply wrong? Let the chart, not your wallet, tell you where the exit belongs. And you must give it room to breathe. Place your stop too tight, right up against the price, and normal daily noise will stop you out constantly. Place it a sensible distance beyond the typical wiggle, accounting for how volatile that particular stock is, and you survive the noise while still being protected from a real breakdown. A jumpy stock needs a wider stop than a calm one. There's also a beautiful link to position sizing here. Once you know your entry and your logical stop, you know your risk per share. From there, you can size your position so that if the stop is hit, you only lose a small, pre-decided slice of your account, say 1 or 2%. The stop is not just protection. It is the foundation of sane risk management for the whole portfolio. But now the most important caveat in this entire episode, and it is a big one. The stop loss is a tool for active traders holding individual stocks. For the long-term index investor, it is usually a terrible idea. Think about why. If you automatically sell your broad index fund every time it drops a certain amount, you would be selling into every single crash, locking in losses, and missing every recovery, which is the exact opposite of the patient strategy that builds wealth. The buy and hold investor's edge is precisely that they do not flinch and sell in a downturn. For them, a stop loss would sabotage the whole plan. So we end with a clear divide. If you're actively trading a single stock, a well-placed stop loss, set just beyond a logical level and given room to breathe, is one of the most important risk tools you own. If you're a long-term investor steadily buying a diversified index, your strategy is the opposite. You deliberately ride through the storms. Know which game you are playing, because the right answer flips completely between them. I'll see you in the next one, where we tour the power tools inside TradingView. Until then, keep it simple, and always know where you are wrong before you are right.